Hello, everyone. My name is Joe Furlong, and welcome to the AiCR Exchange. In today's episode, I am speaking to Nick Dorn. He heads up our whole loan trading desk at MIAC. Nick, thank you for joining the episode.
Thank you, Joe. Thanks for having me.
Well, you know, what is a very interesting time in the whole loan trading desk. A lot of people may know the mortgage industry, but a lot of people may not realize that there's a lot of loans that get traded back and forth between buyers and sellers all the time. And I'm really interested to hear, what does your trading desk do on a daily basis at a high level? Can you give us the overview?
Yeah, sure. So our whole loan trading desk, I manage basically any trade that's not an agency trade. So MIAC has a separate group called a secondary solutions group that handles any agency trading. But everything else from a mortgage perspective, and really other debt as well, would fall under our purview. So that includes seasoned performing loans that are held by banks and credit unions, what they call jumbo mortgages, non-QM, non-qualified mortgages, what they call scratch and dent, which are loans that an investor may purchase and force the originator to buy back due to some defect in the underwriting, non-performing loans, and EBOs, which are early buyouts, or effectively Ginnie Mae non-performing loans that a servicer buys back from the agency. And then in addition, we also trade unsecured debt. We've done both distressed and performing personal loan transactions, auto loan transactions, really anything that is debt related, we've likely seen or traded in the past. So we traffic in all of that.
That is a lot. I mean, I'm actually shocked on how many different things you do. I always assumed it was just mostly residential. Not, it seems like you do everything. So, I mean, if you, what is your top product do you do? Is, I know you mentioned scratch and dent. Is that what you do most of all? Well, what do you do mostly? I mean, you can't do everything all the time.
Yeah, no, we certainly, the majority of our trades are certainly residential mortgage loan trades. We have done commercial loans. We've done bridge loans, fix and flip, but absolutely, really, as a function of who MIAC is and what we do. Our analytics platform is mostly centered around residential loans and banks and credit unions that originate that kind of stuff. So that is by far going to be the most typical product that we trade. Is although it does cover a lot of different potential products, like we talked about, scratch and dent.
So let's talk about scratch and dent here for a second, because this is actually interesting to me. Now, correct me if I'm wrong. This is my understanding on what a scratch and dent is. So you have a bank out there, a mortgage lender. They originate all these loans for Fannie, Freddie, Jenny, or whatever the case may be. And then they originate them, they do all their thing, they deliver them to the agencies, and for some unknown reason, there may have been a defect along the way where the agency kicks it back. And then that lender now needs to get the liquidity on it, because they're not putting those loans on their balance sheet. They originate them to sell them to the agencies. And that scratch and dent, meaning there's that defect that they can't sell to the agencies. And are you saying that then the bank takes that, goes to you and say, hey, Nick, I got all these loans I can't sell to the agency. Can you help me find another borrower that wants to buy them? Did I describe that right, or did I totally mess that up?
No, you definitely didn't totally mess it up. Yes, there is so most mortgage bankers will originate a loan, and they typically will put it on a credit line for a short period of time until they sell it off to either another investor or an agency, which is what you described. And yes, typically it's like an underwriting error, but occasionally it can be problems with the documentation on the loan, the timing on when disclosures were provided, the correct disclosures were or were not provided. Um, and sometimes they just have what are called early payment defaults, where the borrower missed a payment early on in after the origination of the loan, and due to the agreement with the investor that's purchasing the loan, they are required to buy it back if the borrower misses a payment in the first couple payments. So um, sometimes those will come back and they'll be fine, and they'll, basically have no other problem with the loan other than, the borrower missed their first payment or something, and they'll perform well. And then, yes, there's an active market of buyers who will buy those loans because typically a mortgage bank does not, they don't have like a spread, a real spread between the origination of the mortgage note and what they have to pay on the warehouse line. So it's typically a better option for them to liquidate the loan and sell it off to an investor who's, out trying to pick these off for a portfolio. So
So realistically, the mortgage lender typically, and that's the thing, they're just trying to get that upfront premium. So when you sell it, I know there's a lot that goes into it, but when a mortgage lender sells in the Fannie and Freddie, it sells for more than 100%. What does it usually sell for generally?
Actually, that would be a good question for our secondary solutions group. I don't handle, I only handle non-agency trades. So outside of, they're definitely sold at a premium. They can be pretty high premium depending on the quality of the loan and market characteristics and when it was originated,
All right,
what type of loan it is. So but it could be a 105, it could be 105 plus.
okay, so you definitely get a premium, but when you sell in the scratch and dent market, I'm assuming they're not going to get the full premium for it. Do they actually get par, or is it below par?
Yeah, so it's a pretty wide range of potential sale prices, and it's pretty dependent on what the defect is. So, for instance, a very high loan to value loan that the defect resulted in it not getting mortgage insurance. So it originally got, was approved for mortgage insurance. The borrower, the lender thought they were getting MI. The MI got canceled, and now you've got a high LTV loan without mortgage insurance. That loan will sell at a discount pretty much regardless of the other characteristics of the loan and even the coupon. Now, a loan that has what I would classify as like a minor defect would be, like maybe a slight miscalculation on the underwriting that resulted in an AUS findings that now are refer instead of accept. But otherwise, maybe they've made 6 or 12 payments, and it's got a market level coupon on it. Those may sell at par, or just below. It's not typical to get a premium on scratch and dent loans. It does happen, but it's not typical. Usually, you're at kind of par is you're real happy at par.
Yeah, I can imagine.
High 90s prices are pretty good. And yeah, if you can be in the mid to high 90s on a scratch and dent pool, that's pretty good.
So you're just saying, and I interrupted before, that there is a ready market of investors out there that are looking for this type of product that may not be able to be deliverable to the investor, but they want to balance sheet it, and they can buy it at par or even below par, and it's a pretty good investment for them. Did I understand you correctly?
Yeah. Typically, investors will the loans. I mean, the ones that pay the best price are the ones that can. Okay, I think I'm back.
Yeah.
They can securitize it. They can pool up the loans into a big, large portfolio loans and be able to do a securitization and sell them off to regular investors. They'll typically pay the best prices, but there's some stuff that kind of falls out of their realm of what they'll purchase, and there's still other investors that'll take on that risk as well. But you start moving down the pricing, the pricing scale from there typically.
So let's just kind of shift the gears a little bit. Obviously, if you're in the mortgage business and you go to any conference or you read any trade magazine or anything, all you hear about is non-QM this and non-QM that. It seems like that is the product of the day. Are you seeing the same thing? And if so, what are you seeing in that non-QM world?
So non-QM is it's a small piece of the overall residential mortgage market, but a growing piece. And it's what we're seeing on our side when we've put out non-QM pools is we just see a lot of bidders, a lot of interest from investors, and good prices really. I think that's kind of a summary of
does the non-QM price better than agency, or is it equivalent, or is there because why is the non-QM so popular right now in your opinion?
Well, they're very different products. Non-QM loans are different underwriting standards typically than agency. Agency is going to always be a full documentation underwrite, or it's run through an automated underwriting system that requires I believe just about every instance still pay stubs, W-2s, but and tax returns if someone's self-employed. So a non-QM loan is going to use different metrics to calculate the borrower's income typically. So there's a whole gamut of different product types, underwriting types. They do P&L loans where they get P&L from the borrower's CPA and use that to qualify the loan. They do bank statement loans where they look at bank statements to determine cash flow in and out. For a borrower, they do what are called DSCR loans, which are investor loans where they get either actual rent or they get an appraiser to go out and tell them what market rent is for the property, and they use that to check to make sure that there's expected to be sufficient income from the property to be able to cover the debt service so the borrower can get a loan. We typically see higher higher down payments on non-QM loans. So it's really it's not as liquid as being able to just sell to Fannie and Freddie. So it's a much more dynamic environment. Instead of, I guess Fannie and Freddie have very standardized underwriting since they use AUSs. So, a Fannie loan is a Fannie loan, is a Fannie loan. Whereas if you're originating a non-QM loan to a certain set of guidelines to a certain investor, you may have another investor who buys the same product, but has different requirements for, what, what they might accept or the way it needs to be underwritten. So it's not as standardized of a product. So there's a lot of nuances involved in trying to find the right counterparties.
So tell me, Nick. Okay. Is the client on yours the one selling the loan, or is it the one buying the loan?
So we would work with either side. MIAC operates as a broker, typically, so we don't take a principal position in the loan, which means we're not buying it for our own balance sheet or flipping it onto another investor. It's a transparent process from our perspective. But we work with both sides, so we'll either contract with the seller or the buyer on any given transaction.
Well, that's interesting. So tell me about when you're representing the seller. Let's go that route. What does that typical sales process look like? Can you summarize it? Like, what are the major steps? Are there any things that you need to watch out for, or something that you've learned from experience that you tell the seller, let's do X, Y, and Z to have better execution? Can you help us understand that process?
So, yeah, I mean, I guess the best way to probably describe it is just walking through the process. So, like I said, we operate as a broker, so we don't take a principal position in the loan. For sellers, it always starts with a conversation about what their goals are, what they're trying to accomplish with the sale of the portfolio. Typically, that'll lead to the seller providing us with a data tape. And what we'll do is we'll analyze the data tape, and we'll identify, number one, if there's any missing information that investors are going to need in order to bid the loans, if there's any information that maybe should not be included for an offering, but provided post bid to the investors. We'll scrub the data and make sure there's no glaring errors or any issues. Sometimes we'll look at a couple sample loan files to make sure that the seller has everything that would typically be needed by a buyer for sale if they need us to do that. We'll also help with pricing expectations, and we'll help them kind of comb through the portfolio and see if there might be some assets that need to be carved out from the sale or not included. We can help them with that as well. Once we've kind of got the data straightened out, the next step is going to be to put together an offering memorandum. And we typically recommend running an auction to get the best prices, best execution for a sale. So what that usually entails is putting together an offering memorandum, kind of a summary of the assets that are in the sale, what type of a sale the seller is looking to do, whether it's a servicing released sale, or they want to retain the servicing. If there's some nuances into timing expectations or collateral, meaning if for some reason they don't have some specific documentation that would otherwise be required, we want to put that up in the front. And also, if there are any defects in the loans, like we were talking about scratch and dent, we do a lot of reviews where we'll go back and forth with our sellers to kind of I guess put enough information out there that the buyers kind of know what the defect is and it's not vague, because that can result in repricing later on down the road, because maybe the bidder who bid the highest price was unclear about what the issue is, or thought it was something different than it was. And then once they're in diligence, it's a little more difficult, although we can help with that as well, to reprice loans. So we would put out an offering memorandum, get bids for the loans, typically put together what I call a bid reconciliation for the sellers, so that they can look at who the different counterparties are, what their pricing is, if they've got any specific stipulations that they're making that are relevant to the trade that, we've identified as, problems in previous trades, or there could be an issue going forward, or in diligence. We want to, again, similarly, we want to try to identify any of those issues before we're in the diligence process, and people have spent money and time and effort. And then we have to basically renegotiate for repricing. We'd much rather have a clean sale that, hits on what we originally bid it at.
So that's a lot, Nick. How long does a typical sale take to complete from beginning to end?
Yeah, so a typical sale, I guess, I generally would say 45 days from when we initially kind of start talking, if everybody's motivated, and specifically the seller. Usually the buyers are fairly motivated.
45 days is
big time constraint.
Yeah, getting all that done in 45 days is a lot of work to do in a very short period of time. So I guess you got your systems down pat to really to move this along in a very methodical, deliberate manner, I guess.
Yeah, definitely. And we also, one of the things, another selling point that I make to sellers in our pitch is usually that, we quarterback the process once we get into diligence. So once those bids are made, we help to manage the transaction. So we get both of the parties together. We keep everybody on a timeline to provide the documents, in a timely fashion for the buyer to get their third-party reviews done in a timely fashion to, help negotiate any issues on either the agreements, or, if something doesn't match the steps or an issue comes up, we've got, other trades that we can look at. We've got, experience in this business, so we can, rather than, run into a stalemate between, the buyer and seller on some issue, we can provide some guidance and advisory help, on a solution that is, is market, is typical in the market, and, also makes sense, and hopefully, works for both parties.
So over the last, specifically the last 60 days, interest rates have shifted. I'm talking the 10-year T-bill as an example, has shifted significantly. I think it went up 60 basis points, and then now it's starting to retrace a little bit, in particular today, but a 60 basis point move in the 10-year T-bill in a very short period of time is a significant move. In addition, you see increasing delinquencies, in particularly FHA world, where, people may have bought a house with a high interest rate and are having troubles kind of maintaining that debt service. Are you seeing this volatility, especially recently over the last couple of months, being a hindrance, or is it something that the buyers just know it is part of the deal and they don't really necessarily care? Can you tell me about these headwinds that are out in the market today?
Well, so from an interest rate perspective, we've kind of, I guess, flipped over the last few months. There was, with the Iran conflict, and with inflation just staying stronger than expected. I think there was a lot of expectation that the new Fed chair was going to, push to get rates lower, but that the Iran war, or Iran conflict, and the and inflation being, a lot harder to wrangle than I think people had originally thought. It seems like the expectation is now flipped from, that it was going to be a little short term and we were going to see some rate cuts, to, now rates are, probably at least staying pat from the Fed's perspective. And I've even heard, or read some indications that, they may need to do a hike at the next meeting. So
because of that, are you seeing your clients saying, well, I'm not going to be so aggressive buying, or they're saying, I don't care, I'm just going to price it in? What do you see about demand? Is that
yeah, no, it definitely gets priced in. And I would say, it restricts especially on new production, new originations, it restricts the supply, because there's, just less people out there that are able to buy homes and afford the mortgage, with a higher mortgage rate. So it restricts the supply. The investors still want to buy, whatever they can, at these levels. There's, like I said, a lot of interest in mortgages in general and non-QM. So it just makes it a more competitive market, but it constricts, or can constrict, the spreads a little bit. So they get a little more aggressive and more competitive, and pay better pricing.
So
It could be.
Go ahead.
Oh,
Sorry.
I was going to say, some evidence additionally might be, the pricing that we see on non-performing loans. You mentioned, delinquency rates picking up a touch. We've seen a few more non-performing loans in the last few months than we've seen probably in the last couple of years.
Wow.
from the trade desk. And pricing on non-performing loans has been absolutely stellar, in my opinion. I've managed and ran funds that bought non-performing loans on a large scale, and I would say the pricing that we're seeing from investors on non-performing loans is about as strong as we've ever seen.
Wow. So that really leads into my next question. And given the only, we have 2 more minutes left in the show today, I was really going to ask you, what do you expect going forward? I know no one has a crystal ball, but clearly you have your pulse on the market, what's going on. Do you see it continue with non-QM? Do you see it more going into the non-performing market? Where do you see for the rest of the year?
Yeah, so my expectations is that we'll see kind of a continued but steady flow of non-QM. I think we'll see more and more non-QM, a continued but steady flow of non-performing product. The only thing, that I could see really kind of shaking that is, some macro, change. Either, inflation gets all of a sudden, gets way under control, and we get out of the Iran conflict, and things really stabilize, or we start seeing some weakness in the job market, but that just hasn't happened yet. So my outlook would be, I think we're going to continue to see kind of a steady flow of non-performing loans, but absolutely more and more interest in non-QM, and more competitive interest in both products.
Well, Nick, I want to thank you for taking the time today. You've given a tremendous amount of information in a very short period of time. And if anyone wants to reach out to you for to talk one-on-one on loan sales, what's the best way to get a hold of you? Via LinkedIn, via email, call you? How would you want people to reach out to you?
Yeah, so LinkedIn is fine. You can, our contact information is on the MIAC website, so MIACanalytics.com. And then those would probably be the 2 easiest ways to get in touch.
Wonderful. So I want to thank everyone that has joined the show today. And of course, always appreciate you following AiCR and myself on LinkedIn, and of course, Nick on LinkedIn. I really appreciate everyone's time. And Nick, thank you for your time today and the valuable information you convey to everyone. And I hope everyone has a wonderful day and the rest of the week, and see you next time.
Thanks, Joe.